I'm going to talk about some work that I'm doing with one of my students, Victor Nagai. One of the things that we've seen in the last few days and last few weeks is that the Eurozone crisis is back. We saw Spain starting to dominate the headlines again, and then of course last Sunday we had the French and Greek elections. It's possibly now as serious as it's been at any time since it started about 2 years ago. And well, the strategy that the governments and the Commission and the ECB have taken is to try and make sure that there isn't any fiscal problem. So their analysis of the problem, particularly of the German governments, is that what the problem is that countries are profligate. They want to go out and spend money, and they don't have the fiscal discipline they need to be part of a monetary union. Now, I think for Greece, there's some truth to that. The problem is that for other countries, particularly Ireland and Spain, as we'll see, that's not what the problem was. They had these massive real estate bubbles that burst and caused huge pain for their economies. Now, the big issue is, will the strategy that the official sector's adopting work? And what I'm going to argue is that I think it won't, and what we're seeing, particularly with the elections, is popular opposition to these austerity measures, as they're commonly called in the press. And what I'm going to suggest is another set of mechanisms which are gradually coming into place, not through any particular design, but just through the way that the situation is playing out. But I think that those have the potential to take us out of the crisis and solve the problem. Now, if you go back to the beginning of the design of the Eurozone, back in the early 1990s when they put the Treaty of Maastricht into place, there was a great concern that governments wouldn't be fiscally responsible, and as part of a monetary union, this would cause a problem. The answer for that they came up with is the Stability and Growth Pact. There are many elements to it, but the two most important is that governments were required, except in exceptional circumstances, to have a deficit of 3% or below, and they were required to have a debt to GDP ratio of 60%. And the question is, first of all, how did this system work? Well, to get the whole thing going, what they needed to do was to have countries with very divergent economic situations converge. If you think about Italy at one end of the spectrum and Germany at another. So there were various elements to that. The first was in terms of inflation rates, so they gradually wanted to have convergence of inflation rates. So the idea was that you couldn't, if you were going to join the euro, exceed 1.5 percentage points above the average of the three lowest. Then we had the requirements on government finance that I just talked about, the 3% deficit and the 60% ratio. And then there were requirements about exchange rates. You had to join the exchange rate mechanism, which was essentially holding exchange rates within a band, and then you wouldn't allow to devalue as you approach the date that you would join. And then there were requirements on long-term interest rates too. Now if we look at the 3 years prior to the first phase of the Eurozone, I'm going to focus on the 12 countries that were a part of that. Subsequently, we've seen another 5 join. What you can see is the blue line is 1996, 1997 is red, and 1998 is green. So in terms of the deficit, Greece clearly didn't satisfy things. they started to move towards the 3%, but they were still outside that. And as we'll see, they were also not in compliance with the debt to GDP ratio. So they got pushed back. So instead of starting in 1999 like the other countries, they were in 2001. Italy also had a big problem in 96, but they made Herculean efforts and pushed their deficits below the 3%. Belgium was slightly outside, Portugal and so on, but by and large, most countries got within the 3%. So that wasn't so much of a problem, except for Greece. Now, if you look at the gross government debt to GDP ratio, you can see that there are three countries that stand out. The first is Belgium, and Belgium's had a debt problem for a long time. They managed to get it down a little bit in the 3 years prior, but still it was way outside the 60%. Then we have Italy. Again, they got it down a little bit, but not much. And then we had Greece. Now, Greece was, as we discovered later, cooking the books. They actually weren't doing as well as it seemed at the time. But as I said, they got pushed into 2001. Now, what about Belgium and Italy? Well, they were founding members of the European community. And so they decided to fudge it. The European Commission and the Council decided that what was important was, as long as you were moving in the right direction towards the 60%, it was okay. So that was the first relaxation. You can see that most of the other countries were fairly close to the 60%, so they weren't so much of a problem. Well, the question is, did the system work? The problem was that the first countries to get into trouble were Germany and France. So in 2002, as we'll see, Germany was in violation of the 3% deficit rule. Now, what they did was to come to an agreement with the Commission that if they took remediatory action, then they wouldn't be subject to a procedure from the Commission. Now, soon after that, France also exceeded the 3%, and the Commission brought an action against them. So in November 2003, the Commission took the evidence for both Germany and France to ECOFIN, which is the Council of the Finance Ministers. And they argued that they had not taken the steps they should have done to reduce the deficit. Well, what Germany and France then decided to do was to go to the other countries and to persuade them that the penalties that were associated with breaking the provisions of the Stability Code and Growth Pact should be relaxed. So that's what they did. And this was really a very bad way to start it. And I think Germany and France now greatly regret that they actually were the first to violate it and that they used their political power to remove the penalties from themselves. What they then did was to reform the pact and make it less onerous. So they loosened the escape clauses. So there are these clauses like the ones as long as you're moving towards things and so on. They loosened those. They lengthened the deadlines for taking actions against countries, and they allowed longer adjustment periods. Now, I think it's interesting to look at the effects that these measures had. And we've broken it up into the different countries. We start with Ireland, Luxembourg, and Finland. And you can see that as they approach the date for the launch of the euro, these countries actually run significant surpluses. So their governments were taking in more in tax revenues than they were spending. Now, interestingly, once we got into the euro phase, so once they'd established it, they dropped down, but they dropped down to around 0. So this wasn't a big issue. And then some of them ran surpluses again and so on. Now, if we look at the next group of countries, which is Belgium, Germany, Spain, Netherlands, and Austria, you can see the same kind of effect. As we approach the 1999 launch, these countries changed their deficits drastically, and some of them, like the Netherlands, started to run surpluses and so on. And this was an attempt to get their debt down. But again, as soon as we get into the euro part of the graph, what we see is that they relaxed and the deficits went down. And you can see the red line, that's Germany. That's the problem that got them into the trouble with the Commission. And you can see that France, in a minute, will also go down. But interestingly, Austria is also down. They broke it. And so it wasn't just Germany and France, but Austria quickly went back. Germany took some time. Now, if we look at the next group, these are the countries that have problems. Now, as you can see, Greece is significant problems. They've hardly ever been in compliance with the requirements of the Growth and Stability Pact. Portugal is also problematic. You can see that Portugal is the lower orange one, and they've had problems. And then we've got France, which also, as you can see, broke the deficit. Italy, interestingly, did have problems, particularly in the mid-2000s, but earlier than that, they had made a huge effort to get into shape there. But the real problem was France and Germany, and the fact that they were the first to do it, and they used their political power to make sure there were no penalties. Now, if we look at the Eurozone debt, what we can see again, in terms of starting with the countries that have the biggest problems in this regard, as we saw earlier, Belgium, Italy, and Greece were the countries that had high debt ratios. Belgium did a fairly good job of bringing it down up till 2007. Italy brought it down up to the joining of the euro, and then it was stable. It wasn't exactly going down, but it wasn't going up dramatically. Greece, it was going up, though. Nevertheless, they were allowed to join in 2001. Here are some of the countries that were able to get within the 60% limit within the required time frame. Ireland, you can see, is one. Spain is another. Netherlands and Finland. And those countries all did a pretty good job of bringing their debt down. And again, notice that Ireland and Spain actually did fairly well. They were countries which were in good compliance. And here we have some of the countries that didn't do so well. Again, Germany and France stand out here. That's the red line and the orange line. And you can see they did bring it down as they joined, but very soon after that, they were rising and moving away from the 60%. So they not only violated the deficit, they also violated the debt to GDP. And notice Portugal there wasn't that highly indebted at that stage, but it starts rising and goes above. So in fact, if you go back before the crisis in 2007, all the countries, with the exception of Luxembourg and Ireland, violated the 3% deficit rule. So every single one of them. France, Germany, Greece, Portugal, as we've just seen, they increased their gross debt to GDP ratios. This was all in violation of the Stability and Growth Pact. But no countries were penalized. By now it was realized that that wasn't going to work. Now, interestingly, if you do a comparison after the start of the euro, what you find is if you compare these countries in the euro with OECD countries, it really didn't seem to have much effect. It certainly worked at the beginning. In order to qualify, you had to try and meet these goals, and countries made a big effort then, but they didn't subsequently keep up, and nobody really cared. They didn't really do anything about it. Now, after the crisis started, and clearly that was an exceptional circumstance, but basically pretty much all the countries, with a very few exceptions, violated the pact. Now, interestingly, there are 4 countries out of the whole EU, so this isn't just Eurozone countries, it's the whole EU. There are 4 that satisfy. One is Estonia. They have a 1% surplus and a 6% debt to GDP ratio. Luxembourg, which has a 0.6% deficit and an 18.2% debt to GDP ratio. Finland at -0.5 and 48.6%, and Sweden at 0.3 and 38.4. Now, Sweden isn't a member of the euro, so basically there are very few countries within the Eurozone that are satisfying the criteria, and they tend to be very small. Luxembourg's a tiny state, Estonia is also very small, and even Finland isn't a very big country. There are 2 other countries which are currently okay, which is Bulgaria and Denmark, but they are still subject to what's known as an excessive deficit procedure because they were in violation. Now, it's interesting to note these countries. They're either rich countries like Luxembourg, Finland, Sweden, or Denmark, or they're former communist countries which are used to austerity. But the basic point is this hasn't worked. It's been tried and it hasn't worked. Now, what about the market? How did the markets perceive all of this? Well, you can see that if you go back to the early 90s, interest rates for the different countries were all over the place. So huge spreads, and not surprising, these countries ran independent monetary policies and were very different economically. Now, as we started to approach the 3 years prior to the introduction of the euro, we saw convergence in government bond yields. And by the time we got to the launch, they were pretty much together, except for Greece, which, as we said earlier, had an exemption to go to 2001 and join there. So they had a little bit of a difference. Now, once they joined, though, what you can see is these lines basically are all together. There were some spreads, but they were tiny. So Greece, relative to Germany, was 20, 30, 40 basis points, that kind of number. So what's interesting about that is, in finance we argue markets are efficient and they're the best thing available out there. But what happened here is the markets completely failed to predict what subsequently happened. And it's very interesting because many people were quite surprised at these spreads. Greece was an independent country, became an independent country in modern times in 1829. It's defaulted now, including the one a few weeks ago, 6 times, and it's been in default for half of that time since 1829. So it's not surprising that they're back in the centre and they've done it again. And yet the markets attach such a low probability to that, despite the fact that Greece was well outside the parameters in many cases. Now, as I said, Greece arguably is a fiscal problem, but Ireland and Spain aren't. And they were in many ways the poster child for the Stability and Growth Pact. They had low deficits and low debt. Now, once things started going wrong, and we got into 2010, 2011, the EU came back and they passed what's known as the Six-Pack. And this is what's called EU secondary law, which means they pass it in Brussels, but it applies to the countries. It doesn't have to be passed through each country's parliament. So what they did was to have more of the same of the Stability and Growth Pact. So they strengthened the budgetary surveillance and the coordination of economic policies. They changed the way they did these excessive deficit procedures, and they had enforcement of budgetary surveillance. And then they had requirements for the fiscal framework. They were worried about macroeconomic imbalances, so they did understand that they needed to do something about the kind of thing that happened in Ireland and Spain with these massive real estate bubbles. So they had regulations to prevent and correct macroeconomic imbalances, and then they had enforcement of actions to correct excessive macroeconomic balances in the euro area. And that's known as the Six-Pack. My own view is I doubt very much how many Europeans know what a Six-Pack is, since they don't tend to have beer in that form. So, 2011, things were still not going so well, so they decided to make some more changes. They increased sanctions if you violated the Stability and Growth Pact, and they changed the way that the decision-making was made. So before, as we saw, what happened was with Germany and France, what needed to be done to impose penalties was for the ECOFIN, the Council of Finance Ministers, to actually pass a resolution that they would be fined. Now, as we saw, that didn't work, so then what they did in the 2011 reforms was to have it so that it was more automatic. Some countries wanted it to be completely automatic, but again, there was resistance to that, and so what they did is what's known as reverse qualified majority voting, which is if the Commission now says they should be fined, then to overturn that you have to have a vote which requires a majority to overturn it. And you can see laid out here what the various sanctions are, which is if you don't respond to what the Council says you should do, then you have to start putting money as a deposit. And it's 0.2% of GDP to start with. If you go farther and you don't take enough actions, then it becomes a non-interest bearing deposit. And then if it goes farther, then you get a fine, which is 0.2% of GDP. And we can keep on going, and you can get fines up to 0.5% of GDP. They have complicated preventive arms to try and stop you getting there, and then they have these corrective arms, which are again fairly complex to get you there. They have macroeconomic imbalance procedure, as we saw as part of the Six-Pack. They look at a whole range of macroeconomic indicators to see if you've got real estate bubbles and current account deficits and so on. But these are all similar to the Stability and Growth Pact. Now, they also work with a lag, so they just released the first alert mechanism report based on 2010 indicators. That's when the whole thing started, so we're still back. But it's just taking too long, and it's a problem. Now, last fall, we saw again a massive crisis, and what was the reaction to that? Well, now they wanted to have what's called the Fiscal Compact Treaty. Now, the UK vetoed it being a primary treaty among all the EU participants, So it's now just an intra-governmental treaty among the willing members. So this is like the Schengen area. So the Schengen area, that's the area where you can travel in Europe without a passport and just go across the borders as though it was like being in the US. If you go outside that, so for example, if you go from France to the UK doesn't belong to the Schengen agreement, then you have to show your passport. Well, this is going to be a similar kind of agreement. It's the countries that want to do it will do it. Now, what they're required to do is to introduce a balanced budget amendment into their constitution, which is going to limit the amount that they can have as a deficit. Also, if debt exceeds 60% of GDP, then you've got to have a trajectory of debt going towards the 60% limit. And then, if you're in excessive deficit, you have to submit an economic partnership program, so plan basically to get back. So again, this is nothing really different from the Stability and Growth Pact, which they've tried, and yet this is what they're putting all their hopes on so far. And as we've seen, it isn't working. Nobody really believes this because of the politics. You know, the notion of fining countries when they're in desperate trouble is not a very sensible one. Either the fines are too small to make any difference, or they're too big that they won't be applied. So if you think, you know, Spain is in desperate trouble, and we'll talk more about that in a minute, you know, they've got unemployment now to 24.4%, youth unemployment is 52%. Are we really going to see that the European Commission fines them 0.5% of GDP, which is just going to exacerbate all their problems? And so I would argue that this is not an effective strategy. And even if they pass the treaties, we're going to see referendum in Ireland on May 31st. Only 12 countries have to pass it for it to become law, but we've still got some bumpy way to go. But even if it passes, it seems to me it's not going to work. It doesn't deal with what I think is the real problem. Greece is a problem, but you know, they should never have let Greece in. If you look at those numbers, that was a big mistake, and probably, arguably, they shouldn't have let Italy in either. Now, Ireland and Spain, though, are an important problem. As I said, they were really the poster countries for adherence to the Stability and Growth Pact, and yet now they're in desperate trouble and they're in violation. And the problem is that they had these macroeconomic shocks, these huge boom-bust cycle, which were much bigger than anything anybody anticipated. During the last 20 years, we had what the many macroeconomists call the Great Moderation, and I think they perceived that there wouldn't be these massive shocks, and so if you had a monetary union, you could have adjustment within the union. It might be painful, but it wouldn't be the huge kinds of problems that we're seeing in Spain, particularly at the moment. Again, the Germans' view of it is what you need to do is just control the fiscal situation of countries. But what we're seeing is that, in fact, this notion that if you cut deficits, it's actually going to lead to growth, which was actually a serious argument that a number of people made a few years ago, it just doesn't work. If you're Spain and you've got this massive deficit, 8.5% of GDP last year, and if you start cutting, what happens is you get into a more severe recession, unemployment goes up, and things just get worse. Growth goes down, you shrink more. And these are terrible for the populations. Now, Spain is a good example here. That 52%, 51.1% is a lost generation. These are people who probably won't get permanent jobs for maybe 10 years, maybe 15. By that time, they'll be competing with young people they probably won't ever have serious careers and have stable jobs. So the human cost of these policies is terrible. And that's what we're beginning to see with the elections last week. Greece is in a similar situation to Spain. They have about 21% unemployment, coming up to 50% youth unemployment. The main centrist parties had agreed with the Troika, the EU, the IMF, and ECB, that they would have this austerity. They signed letters that they wouldn't reverse that even if they came to power. But what's happened is that the voters have basically turned them out. So the two parties, PASOK and New Democracy, have basically ruled Greece since they stopped being a military dictatorship in the 1970s. The last election combined, they got about 70%, and now they're down to the low 30s between them. They lost 40% of the electorate's votes. And that's a popular reaction to these anti-austerity drives. And we're seeing a similar thing in France. Sarkozy was very much for these measures. Hollande won, only just, but he did win. And what's he going to do? He's going to reverse some of the austerity measures. So French raised their retirement age from 60 to 62. Hollande's going to put it back down to 60. The Germans look at that and they retire at 67, and they're a little bit upset about that. So the ballot box is paying out. The Netherlands is the other interesting country. They're one of the fiscal hawks. They wanted to have Greece and all these other countries cut. But when it comes to themselves cutting, the government fell. Now, they did manage to get a package through, but they'll have elections in September. Now, one way to deal with it is to actually have transfers. What we've seen so far is lending money. That's for what these bailouts have been. They're not really bailouts, they're loans. They're at below market rates, so in that sense, they are subsidized. But you can get away with that, and the voters, I think, don't fully realize that. But the next step is that they write off loans. And this is what's interesting in the Greek situation, because the Greeks are now in a good situation for negotiation, because they've got a democratic mandate. It's likely they're going to have another election, and it may well be that the far left party will win. But if Spiros gets to be the Prime Minister, then he's going to have a very potent threat, which is, if they default, basically they've already defaulted on the private sector. They took a 75% loss in NPV. So there's not much of them left. So the next default is going to be on the official sector. Well, who is that? That's basically the other European countries and the IMF. Now, it's going to be very difficult for Angela Merkel to explain how she's lost tens of billions of euros with the Greeks defaulting. It's also going to be very difficult for the IMF to explain why they gave these loans and why they had a default. The IMF has never had a default in its history. They've always managed to get their money back. But they've always been in control before, and they're not in control now. Berlin is in control. And the political ramifications of a default for them are huge, because where do they get their money? Well, they get their money from all over the world, and whereas it's fine to take money from rich countries like the US and to go to Europe, there's something very distasteful about taking money from very poor African countries like Niger and Cote d'Ivoire and those kinds of countries, and giving it to countries like Ireland, which is one of the richest countries in the world. And so they're going to have a huge political backlash if there's a default on them. So who knows how the Greeks are going to play it out, but they've got a strong negotiating card. Now, what I want to suggest is that we need to change the institutions to realize the fact that these macroeconomic shocks are much bigger than was anticipated when it was originally designed. And what we need to do is have two mechanisms. The first is we need to have an allowance, a mechanism from sovereign default within the Eurozone. Now, the Greeks have shown how that can work. Now, if you think back, what the ECB said, what the Commission said, what everybody said would, if there's a sovereign default within the Eurozone, this is a complete disaster, we're going to have contagion, the world is going to come to an end. It didn't happen that way. In fact, when they defaulted and had the 75% drop in NPV for the private creditors, pretty much everything went smoothly. There was very little effect. I think that's an important part of the mechanism, because if countries get into trouble, if they have big shocks, that's a good way to get round the problem at the first level. I think for Ireland, for example, this is something they should do. The ECB has been adamant that they shouldn't be allowed to default on the government, on the bonds that the banks issued. But if they could do that, that would be a considerable help to them, and this contagion argument, I think, is no longer valid, and they should do that. But the more important mechanism is temporary, and I stress the word temporary exit from the Eurozone. If you read the newspapers today, there's a lot of discussion about Greece leaving, and maybe leaving the EU. Many investment banks have raised the probability of that to 75%. My own view would be it's higher than that. The way it's put is that this is the end of the world again. There's going to be this tremendous problem, contagion, it's going to have a massive negative effect. Now, I think the reason there's problems with contagion is when something unexpected happens. So we had too big to fail policies for many, many years. When Lehman went down, this was a huge shock to people because nothing like that had happened. And so they didn't know what was going to happen next. I think as long as we realize that this is a possibility, that countries may be forced to leave if they get into trouble, then we can all adapt for it. And if you read the papers yesterday or today, what you see is the banks have already started preparing for a Greek exit from the Eurozone, and it's expected that this won't be too much of a problem. Now, it may be a problem for Spain and Ireland, but again, as long as we've got enough time and we can adjust, my own view is that the contagion problem wouldn't be so bad. Now, what's the big advantage? Well, the big advantage of leaving and letting your currency float is that you can start growing again. The way it's supposed to happen within the Eurozone for countries like Greece and Spain is your wages are supposed to drop. But these countries have very strong unions and they haven't had drops. Ireland has. Ireland's much more like we are in the US. They've had a drop in wages. But Spain, they've actually still been going up despite this massive unemployment. Similarly, in Greece, they haven't adjusted much. Now, what's the example that we can use? Well, it's Argentina. Now, people say, yeah, but Argentina was a disaster, wasn't it? Well, the truth is, no, it wasn't actually. This is what happened in Argentina. Argentina was pegged to the dollar. They had a currency board, it was very like the Eurozone. They got into trouble, they got into a recession, and things started going bad, and eventually they were in a very deep recession. They decided, we're going to leave the currency board. There was a massive drop in the exchange rate, so the number of Argentinian currency units that you needed per dollar jumped up. So you can see it went to about a third of its value. But the key thing is that they started growing very, very quickly. If Greece was to leave, maybe tonight, maybe next week, maybe a few months from now, they would have a similar experience. Friday night, 4 o'clock in the US, the markets close. It's 11 o'clock in Greece. They pass a law. Everything that's in euros under domestic law, 1 euro equals 1 new drachma. The drachma starts to float the next Monday. It would be something like this. It would probably go to about a third or a half of the value. But immediately, they would become competitive. Instead of going to Spain or to France or to Italy for your vacation in Europe, you'd go to Greece because it would be dirt cheap. The things that they do well, like generic jugs, shipping, this would all become much cheaper. They would start to grow just like Argentina. And the interesting thing is they kept on growing. They had a little bit of a blip in the crisis, but they're now 60% above where they were. This has been an extraordinarily good experience for them. Now, it's not just if you use inflation numbers in Argentina are notoriously manipulated by the government. If you use GDP in US dollars, so you use market exchange rates, you get similar numbers. Another interesting reform, people often say, well, Greece would be different from Argentina because Argentina was in a growing world economy. A very interesting comparison is between South Korea and Japan in the current crisis. South Korea, what you see is a similar kind of thing. Sorry, there's something gone wrong with the graph here. But what's happened here is that we get a devaluation, a sharp devaluation, but then they start growing. If we compare that with Japan, we see again. Sorry, the foreign exchange graph has gone up, but basically Japan just went down, whereas South Korea devalued. And again, Japan had a much bigger effect than South Korea, and they didn't grow nearly as fast. They're not even back up, whereas if you look at South Korea, they've gone significantly higher and kept on growing. Same kind of thing in Finland. They had a similar kind of experience. If you go back to the Great Depression, Eichengreen and Sachs argue that in fact the countries that left the gold standard did well. They also argue that it didn't necessarily damage the neighbours more than would have been the case without that. So let me conclude, and then we have a few minutes left for questions. What the EU has done hasn't worked in terms of the Stability and Growth Pact. Their current policies to try and correct the problem is more of the same. It seems very unlikely that it's going to solve the problem. And that's why the markets have been so skeptical and why spreads are at the levels they've been at the height of the crisis almost. The austerity policies are ruining people's lives. There are lost generations in Spain and Greece, at least, and maybe in more countries as we go through what is looking like it may be a quite bad recession in Europe. The alternative is to have default and temporary exit. This is not a rescission of the European ideal. It's just acknowledging the reality that countries find it very difficult to adjust by internal means, and it's much quicker to do it, get back to growth with these kinds of exchange rate changes. They keep talking about a growth pact, the kinds of policies they have in mind, since Keynesian kinds of stimulation are ruled out, are things which take at least 2 or 3 years for product market reforms, 5 to 10 years for labour market reforms, and 20 years for education reforms. That's not going to work. It's just politics, much like what we've just seen here. I'll stop there and